questions. The European Commission is proposing actually to set up a kind of agency, or let's say a mechanism, to wind down banks doing wrong. I mean, bad banks, failed banks, and to set up a kind of mechanism how to manage, how to handle such kind of situation.
Yeah.
I mean, we have such a kind of mechanism. It's you. So why setting up a second one?
Well, this proposal that the Commission made recently is a so-called single resolution mechanism. This is necessary to complement the single supervisory authority, which will be the European Central Bank from next year. It's another element of the banking union that is being created. Banking union has these different elements: single supervisor, the direct bank recapitalization that we may be able to do next year. The single resolution mechanism is not something that the ESM could do easily. We would not have any comparative advantage in that area. But everybody agrees we need something like a resolution mechanism, and it's secondary who does it in the end, but it is needed to complement the functioning of the single supervisory mechanism.
It's still not figured out actually who will close down failed banks. The European Commission is saying, okay, we would like to do it. Germany is protesting. In this debate, which is a real struggle, a power struggle actually, what from your expert view would work out best?
Well, it's important that the Commission has made a proposal, because that always starts a process then in the EU. That's how the European Union is organized. We need a proposal from the Commission, then we have the debate in the Council of Ministers, and then it goes to the European Parliament. There is indeed the difference in view. The German government believes that a treaty change would be needed to create such a mechanism. The Commission argues not, so we have to see what the lawyers believe. I'm not a lawyer, so I don't take side in this debate. But everybody agrees that we need something in place by the middle of next year to complement the single supervisor. And we have seen many instances the last 3 years where initially we had different views in different member states or the Commission. The track record is clear. In the end, the euro area has always pulled together and come to a consensus on the right approach. We have seen this again and again with the creation of the EFSF, the creation of the ESM, with the different programs that are in place. I'm confident this will also happen with the resolution mechanism.
Well, you're confident, but the European Central Bank, Mr. Draghi, is saying, don't be too confident. Actually, time is running out. And regarding the banking union we are talking about, delays are huge and getting seriously, dangerously. So why we have those delays setting up this banking union?
Well, the issues are complex. It's not easy. It's not easy to create a new supervisory authority. The ECB will do it, but it's a new job for them. So they need about a year to prepare themselves. They have always said that they need a year. There were delays in the legal act to be adopted. The European Parliament gets involved in this for very good reasons, but this takes time. 17 democracies need to find a consensus first. And then it's a very complex operation. The supervisor is complex. To create a resolution mechanism is not easy. Creating the ESM was not easy, but it's functioning now very well. But I know exactly what it means to create a new institution. This takes some time. It's important that we are moving in the right direction, and we are doing that. It's important that markets get the impression that it is moving in the right direction. Then it's not so important whether it takes another 2 or 3 months, as long as everybody knows that we will get there.
Regarding this supervising mechanism we have today, the Troika, which is criticized by population in a very harsh way in Greece and Portugal, Spain, other countries around Europe, we still have the International Monetary Fund in this Troika. I'm wondering why we are not just changing this composition. You're stepping in and the International Monetary Fund is stepping out. Why not recomposing this body, which is an European body?
Well, let me first say, when you mentioned that the population criticizes the work of the Troika, this is understandable, but it's also quite normal. We have seen IMF programs for more than 50 years around the world, and when a country gets into trouble, loses access to the market, the IMF normally is the only provider of financing against conditionality. Economic policies have to be improved, and that's normally not pleasant for the population. But we have seen again and again that it really helps, that it puts the country back on the right track to sustainable growth. We saw that in the Latin American crisis in countries like Brazil. We saw it in Turkey 15 years ago. We saw it during the Asian crisis in countries like Korea, Indonesia, all countries that afterwards became star performers in the world economy.
But to relaunch the question about the International Monetary Fund, I've got the feeling that the IMF is getting more and more reluctant actually to play its role in Europe.
Well, they are financing a smaller share than initially, that's true, but they are playing the role in the 5 countries where we do the financing. And the question, what is the role of the ESM that you brought up? We have a different division of labor in Europe. What the IMF does at the global scene when they are called to a country, they do it in-house, everything, the financing, the monitoring, making forecasts, negotiating conditionality. In Europe, we have a division of labor. There's a Troika consisting of the European Commission, ECB and IMF, negotiating the conditionality, monitoring economic developments, and the ESM is in charge of the financing from the European side. And we provide 90% of the financing, for instance, in the case of Greece or Cyprus. So we have a division of labor. We have other existing European institutions that do a very good job. I know what the Commission and the ECB are doing. No need to replace them. In the very long run, we may be able to do all this in the next crisis without the IMF, but in the current crisis, we are happy to have them on board.
Looking around, we have this credit crunch problem, which is a real one. I recently went to Slovenia filming, talking to small and medium-sized entrepreneurs, and they have real problem to get access to capital. There's a kind of time bomb ticking in Slovenia, but not just in Slovenia. So why actually the European Central Bank is handing out 1 trillion euro, and this money is not arriving at the small businesses where it's needed?
Well, we have a problem in all southern European countries. Availability of credit is difficult. Also, the interest rate spreads are high compared to northern European countries. That's a real burden for the economy. The ECB is doing a lot. They provide liquidity. There are now special efforts underway to provide also financing to SMEs via the European Investment Bank, for instance. There's a special program from them. Also, the ECB is looking at the collateral they require for their refinancing, so they make it easier. But there are problems, that's true. It's sometimes difficult to disentangle exactly whether the problem is on the demand side or on the supply side, and it may be both. But when the economy is weak, and it is weak in all southern European countries at the moment, although we see the signs for improvement, when the economy is weak, also demand for credit is weak and banks are reluctant to lend. This is a normal phenomenon, part of the adjustment, but I think the ECB is trying hard to overcome this.
What will happen tomorrow when a bank breaks down? Who has to pay?
Public money, taxpayers' money will be used less than in the past. The bank creditors will be involved more in a more systematic way, including junior debt holders, if necessary also depositors above the 100,000 euro limit. And there are certain rules on that, but the details are still under consideration with the European Parliament.
Critics from the left side are saying that this huge amount of money channeled into those saving actions is channeled back to the stakeholders and is not arriving on the economic level, on the people managing businesses and doing businesses.
Well, that's a bit too simple. It's true that certain amounts of the emergency financing provided goes to creditors of the countries that have provided financing to the government or to agencies in the debtor countries. So the normal debt service can be maintained. But some of the financing also goes to cover the fiscal deficits in countries like Greece or Portugal or Cyprus. So some goes to the debt service. But the debt service is also a government obligation. If a government were to default on this, this would be very costly for the economy as a whole.